Coming hot off the heels of a week that's been dominated by fears around the growing debt burden in the US and Japan, rising yields, and we've finished it off with comments from Donald Trump warning of 50% tariffs on the EU and 25% tariffs on Apple if they don't produce the iPhone in the US. So plenty of volatility in play as we head into a new week that will be headed up by US data, in particular with the core PCE price index being released, but also a rate decision from the RBNZ. So first and foremost, these are the top tier items for the week, according to Trading Economics. You can see here on Tuesday, we kickstart things with the GfK Consumer Confidence Survey out of Germany, inflation out of France, and the durable goods orders numbers in the US. Bearing in mind, Monday likely to be relatively light. Certainly here in the UK, we have got a bank holiday in play. So a long weekend here. So then we move into Wednesday. It's essentially Tuesday night, Wednesday morning, really depends where you are in the world. This is UTC, so it's essentially the zero time zone. So add or subtract accordingly. We've got that rate decision from the RBNZ where the expectation is for another 25 basis point cut. Then we've got the Fed minutes on Wednesday evening. Coming into Thursday, consumer confidence from Japan, GDP growth rate, the second estimate from the US, and Friday, inflation from Germany, the GDP figures from Canada, and then we've got a raft of data out of the US headed up really by that core PCE price index metric. And let's start off with that. So this is the outlook for the US data. You can see here Tuesday, durable goods. We've got a whole host of ones that are going to be relevant, quite frankly. Home price index, of course, as we're seeing the likes of yields moving towards the upside. Of course, there's question marks about how that could put downward pressure on house prices. Consumer confidence, of course, in May. So this is coming at a time where people are feeling a little bit more confident that maybe there will be trade deals coming into play. But the caveat here, of course, is that, you know, for many of these countries, the reciprocal tariffs were already halfway through that 90-day period. And we haven't really been seeing any trade deals. Now we're hearing from the likes of Donald Trump warning of a potential 50% tariff on the EU. And so that highlights that this reprieve that has been provided to markets could soon turn into pessimism. And that's exactly what has started to happen after that announcement. So really, we need to start moving in the direction of seeing trade deals, because if that doesn't happen soon enough, we could see markets start to roll over as a response. So manufacturing index out of Dallas, that'll be interesting also, because we've been seeing significant inflationary pressures of late, and we'll get into that. But then we've got the FOMC minutes, of course, trying to gauge exactly what the perspective is from the Federal Reserve. But of course, the view here really is that there's fears on both sides of the dual mandate. One side, of course, is inflation, and the other side is growth and unemployment. And then essentially, we're going to be looking really towards Friday as the big ticket. We've got GDP coming out, but it's the second estimate. So whether we'll see much of a revision remains to be seen. Initial jobless claims, we haven't seen a huge amount of movement in those jobless claims of late. But then we've got on Friday the core PC price index, personal income, personal spending. So a host of key data points. Now, one thing I would say is that there was a period within April where markets had grown very fearful. Of course, the announcement of these sort of sky-high reciprocal tariffs from Donald Trump had put markets into a risk-off mode. We have since recovered much of that downside for equities, and that's because of the fact that we've seen a lot of those reciprocal tariffs pushed back into the future. Then we saw the deal with China, which dropped it from 125% down to 30%. Well, like I said, we have since seen Donald Trump coming out on Friday and saying that he could hit the EU with a 50% tariff. That highlights exactly how those negotiations are going. And so where we saw deals between the likes of the UK and the US, those are the easy ones. And that was outlined at the time, right? Because the UK already has a trade deficit with the US. So whether we see the likes of the EU rolling over and striking a deal that is against their interest remains to be seen. And certainly as things stand, the tone coming out of the White House points towards difficulties in those negotiations. So if that's the case, then what's going to happen with the other negotiations? We could see a similar kind of thing, and soon enough that fear comes back into play. The reason I mention that now is the fact that ultimately, where we had previously said, look, we can disregard some of the data, even if it worsens for April, because of the fact that we've since struck deals with the likes of China afterwards. Well, if we see those deals then coming back into play or reversed essentially because that 90-day period is over, then what happens in April will be a key blueprint for us to be able to look forward into. And there's also the fact that we still have tariffs, right? We've got those 10% tariffs. We've got the sector-specific tariffs. We've got 30% on China, what was 125. So certainly looking into this data, if we do see a surge in terms of inflation pressures, then that's going to be a warning sign that the Federal Reserve is going to have to stand still, essentially. Now, notably on the inflation side, and we were talking about the fact that we've got those Dallas numbers coming out in terms of the manufacturing sector, you can see here that we have seen a surge in terms of some of these key manufacturing metrics in particular. You can see here the Philly Fed manufacturing survey, the Empire State, and the ISM manufacturing. All three of them, the prices elements have surged of late. But as you can see here, core CPI, core PCE, both of them remaining on a downward trajectory. So we haven't necessarily seen that major uptick to say that tariffs are inflationary. But we have heard from the likes of Procter & Gamble. We have heard from the likes of Amazon. We have heard from a number of companies that have essentially said, we're going to have to raise our prices. Walmart's another one, right? And so we know that it's inflationary. The degree to which it's going to hit the US economy in terms of inflation remains to be seen. Of course, we have seen that downward pressure in terms of energy prices, so that might alleviate some of that effect. But certainly, at some point, it looks likely that these tariffs are going to cause inflation, and that could be detrimental for those hoping to see the Federal Reserve cut rates. And of course, that feeds into the yield narrative. Now, this is the sort of picture when it comes to the US inflation picture. So this is core PCE alongside headline CPI. Headline CPI driven down to 2.3, thanks in no small part to lower energy prices. But core PCE has also been relatively subdued, down to 2.6. We can see in terms of the monthly metrics, we have seen an uptick in terms of the metric for CPI for the monthly figure, up around that 0.2 mark, but certainly not massively elevated. So it's likely we're going to see a higher monthly metric than before in terms of the core PCE. Let's see what markets are expecting here. So core PCE price index expected 0.2. So that would match the core CPI number, or sorry, the CPI number on the monthly metric. But then you look back at the previous figure, the April number, and you can see that you're stripping out a figure that's roughly between 0.2, 0.3, potentially replacing it with 0.2. So you could see the year-on-year metric largely flat, perhaps a little touch lower. So markets are expecting, we don't have it on here, but yeah, if we see 0.2, it's going to be something there or thereabouts where it currently is at 2.6, which, you know, to some, you could say, well, that means that the Federal Reserve are going to feel quite confident. And the question mark here is, you know, what is the outlook for the Fed? Because there's been big fears around the resurgence in terms of bond yields. And that surge in terms of bond yields has dampened sentiment within markets. It's also been driving down the likes of the US dollar. There's fears around the demand or lack of demand for some of these treasuries. Now, it's important to draw a line between the likes of, say, the 2-year yield, the 10-year yield, the 30-year yield. A lot of this focus has been on the long-term yields. We saw the 20-year bond yield auction with distinct lack of demand. Some of the sort of short-term stuff, the 2 years and the like, is certainly going to be more reflective of what the outlook is for the near term in terms of central bank policy from the Federal Reserve. So that's more likely to be impacted, the likes of the 10-year, the likes of the 2-year, rather than the long-term bonds, which have been the most troublesome bonds that markets have been following of late. But nonetheless, if we see elevated inflation coming into play, that feeds into this narrative that we should be worried, because we're also now starting to see the talk of a 50% tariff on the EU. And so all of that feeds into the possibility of further upside in terms of yields. Now, what have we seen recently in terms of the relationship between yields and the likes of, let's just quickly grab the chart. So what have we seen in terms of yields and the US dollar? Well, firstly, I wanted to bring up the US dollar just because on its own, I think it's a pretty compelling chart at the moment. So from a longer term perspective, you can see we're within a sort of bullish trend. But we're within this phase where we've been selling off for 1, 2, 3, and we're in a fourth month of declines here, right? So very clear-cut bearish trend in play. We've got that bearish descending trend line that I've highlighted in the past come into the 61.8 fib area, and we've been rolling over since then. Certainly, as we take out swing lows on the way down, so you become increasingly confident that you're going to break that prior low of 979.5. Notably, the risk off move that we've been seeing in terms of markets in response to that announcement around Apple potentially getting tariffs, the EU getting hit with 50% tariffs. What's the market response? Well, weakness in terms of equities, strength in terms of gold. What happens to the US dollar? No haven demand there. The US dollar weakening off the back of that. And that's quite something. Well, notably, we have been seeing a divergence in terms of the likes of the 10-year yield and the likes of the US dollar. And so what we had seen in the past was a lot of it was driven by inflation fears and expectations around the central bank. Right. So let's say, for example, markets become fearful around inflation. So you price less rate cuts going forward. The expectation is that you're going to see yields rising around that as well. And you wouldn't necessarily see the dollar moving towards the downside. Generally, you see the dollar moving towards the upside as well. So what are we seeing in terms of that move now? Well, instead, markets are growing fearful around demand for yields. For bonds, we're seeing yields moving towards the upside. But we're not necessarily seeing that in terms of the US dollar. Instead, the US dollar sort of out of favor. And so we're seeing that divergence playing out. Higher yields, lower US dollar. So if we look at the sort of short term, we can see here that we had seen a bit of a pullback in terms of yields, but they're starting to spike after that announcement. But we're seeing weakness in terms of the US dollar after that announcement. So again, that divergence coming back into play once again. So certainly yields are going to be a key one to follow. But as we look towards this inflation report, markets are looking for 0.2. But I would say the risk is probably towards the upside. There is, of course, a risk that we do see those tariff effects start to show up in this metric. And if we do, then it's likely we would see higher yields and possibly lower US dollar as a response. So a key one to be watching out for. But just from a sort of pure sort of trend following perspective, we've got a clear bearish phase. We've rallied into a retracement. We're selling off. We're sort of in the mid part of that. You can see here we've come into your first major swing low, which is 99172. We've tagged it. So certainly if we break below that, in my mind, that gives me a greater emphasis on the bearish side of this trade once again, or continue to essentially. And then you'd be looking at this 100.118 as your near-term resistance level to be looking out for as a response. So I'm expecting to see a continuation of this intraday downtrend in the US dollar, and that inflation report will be a key part of that. And then I wanted to touch on the RBNZ, that interest rate decision, with markets 85% sure that we will see a rate cut of 25 basis points. That's down to 3.25. Now, the RBNZ, by and large, did move quite early within this phase. The likes of the RBA sort of sitting on their hands. They didn't raise rates as much, but they also held off in terms of cutting much longer. The RBNZ raised rates heavily, but have been cutting rates heavily. And the question mark here is, at what point do we sort of draw an end to this easing cycle? And will that strengthen the likes of the New Zealand dollar? Generally, you see sort of relative yields playing out in a way that would mean, even if we saw the likes of the RBNZ with much lower interest rates, there's a good chance that once they stop cutting rates, and then you see, let's say, for example, the likes of the Bank of England or the RBA cutting at a more sort of vigorous pace, then that rate yield differential would mean the potential for strength for the New Zealand dollar. But that's not necessarily something that's been playing out of late. We've been seeing some weakness in terms of the New Zealand dollar. Now, the flip side to it, of course, also is the fact that the likes of the Australian dollar, likes of the New Zealand dollar, heavily focused on sort of pro-cyclical effects. So where markets start to feel very confident that the US-China deal has been struck and everything's going to be hunky-dory, well, those economies are very pro-cyclical in nature. So on good days, they can do very well. But at times where we think there's going to be a breakdown in the world order in terms of trade, the likes of the New Zealand dollar and the likes of the Australian dollar don't do particularly well. So as we can see here, expecting a cut this time around. Market's expecting a cut in July as well. And then beyond that, we're maybe going to get another cut. Maybe, maybe not. I mean, look, it comes down to like 45% chance of one in November. So 2 to 3 cuts this year. That's over and above what many of the other central banks are looking to do, quite frankly. The Bank of England at the moment expected to cut rates just one more time this year. That, of course, can change. But I think it's interesting to note that the RBNZ has cut pretty significantly. It's the red line kind of in the middle of this, but having moved much more sharply lower than some of the other lines at the top end here. So they have been easing at a pretty rapid clip. There's an expectation it will continue to ease for at least a couple of times more. And so, you know, there's a possibility that we see that weakness playing out. But like I said, once we move towards the end of that process and they transmit that and other central banks start to pick up their pace of easing, that's where we could see some strength coming into play from New Zealand dollar, in particular if we're seeing sort of confidence grow around global trade environments. So let's just we do it like that. So let's look at the pound against the New Zealand dollar. Quite frankly, I was just looking at the most convincing chart, right? Sometimes I just think, let's talk about the New Zealand dollar and I want to see what the best trend is. And I think it's this, right? So this is the pound against the New Zealand dollar. Look at this lovely channel that we're trading within at the moment. You know, you can draw it however you want, really. I'm just trying to pick up as many of points on the bottom as possible. So you sort of got 1, 2, 3, 4, 5, and we're off the back end here. So what this looks like is a clear bottom for us to continue that trend. Now, if we see a dovish RBNZ coming out, then that feeds into that narrative. If we see weakness in terms of sort of market sentiment for global trade, like the announcement around the EU from Donald Trump, like the possibility of us to start running out of time and that the reciprocal tariffs come back into play, that in my mind is going to strengthen this currency pair as well. Now, you can see that over the course of the sort of month so far in terms of May, what we have managed to achieve is we've completed this double bottom formation at that trendline support. So that's ideal, right? So in my mind, I think this is the bottom. And there's different ways of playing it. We can either potentially wait for an exit from the short-term trend to come all the way back into this zone. That's one way it could play out. Another way is just following this intraday trend. So this is the 4-hour chart. And this looks really nice, right? So we had been seeing sterling Kiwi sort of selling off earlier today. Once we saw that announcement around the what Trump's saying, we're now starting to see it pick up once again. So in my mind, I think that there's a good chance that within this zone here, we're going to see it bottom out once again. So we'll just look at it from a fib perspective and say, you know, that's sort of mid-sized retracement. That's another mid-sized retracement, maybe 61.8. And therefore we can just sort of look at this and see, you know, where are we here? So we've tagged that 61.8 absolutely perfectly there. That's lovely. Let's see what those other ones were, just out of interest. So yeah, that's more like a 50%. It didn't hit 61.8. And then this is the same. So, okay, so we've hit 250s and now 61.8. We are still seeing a little bit of weakness as we try and work out whether this is the bottom or not. But I think there's a good chance that ultimately the bulls are going to come back into play soon enough. Very, very clear-cut trend. We've seen that double bottom formation forming. We've now got this sort of symmetrical triangle here. There we go. So it's all pretty orderly here, quite frankly. And so we've come in, hit the 61.8, popped up from there. I think within this zone here, it's likely that the bulls are going to come back into play. If we break back below this 2.2536 support level, then it starts to look like we could come, like I mentioned before, in for that wider retracement. But until that happens, I'm pretty bullish for this market. I think it's likely that we could see the bulls coming back into play to continue this lovely uptrend that we've got for sterling against the New Zealand dollar. So just 2 to cover this week, but it doesn't mean we're not necessarily going to that we will have a week that's not going to be full of volatility, because quite frankly, as we've seen at the back end of this week just gone, there's plenty in store for us if Donald Trump has his way. You never know when he's going to come out of things, and he's hurting US companies, one of the biggest in the world, potentially the EU, supposedly their ally. So who knows what he's going to say next or what the next developments are. As I've been covering quite a lot this week, there's a big focus on the bond market. So keep an eye out for some of the bond auctions over in the US and in Japan, because by and large, we have been seeing upside in terms of yields, but sometimes it's the auction and the lack of buyers that really drives up price over a short term. And that provides the potential implications for markets as a whole. So lots to look at. New Zealand dollar is a key one. Sterling, Kiwi, the likes of the US dollar, but also equity markets. Gold doing really well once again after that announcement, pushing higher. Plenty to go at the moment. I hope that's been useful. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.